Professor Kroszner, can you glean here a Fed that will change its attitude towards the November meeting?
So I think, as we were talking about before, this is kind of roughly what the Fed was expecting. You've seen a little bit less wage pressure, which is good from the Fed's perspective. We've seen greater labor force participation, which the Fed also likes. That's likely what is accounting for the increase in the unemployment rate. So you're seeing the kind of Goldilocks scenario that the Fed wants, that the labor market is gradually softening, but not cratering. It's taking some of the pressure off, and so that'll take the pressure off the Fed from raising rates. I think it'd be really unlikely that they're going to move in at the next meeting. And obviously, there's going to be a lot more data that'll come out between now and then. But unless there's some major surprise, they're probably likely going to hold through the rest of the year.
Randy, we've got to run, but one more quick question, if I may. It's a dual mandate. Is it really a dual mandate for this Federal Reserve System?
Well, this is the big pivot that came last year at Jackson Hole when Jay Powell said, there's one thing that we're going to do, and he said it 8 times, that we're going to fight inflation. So he basically said, sure, we have a dual mandate, but the inflation part is the most important. This year was kind of more back to normal, that we have to worry about both the inflation part as well as the employment part. And so that's why the Fed's looking so carefully at the data to make sure that they don't raise rates so much that they bring the unemployment rate zooming up.
Right.
It's hard to get that perfect. A lot of people think, the Fed can perfectly engineer this soft landing, that they have so much control that they can move the unemployment rate up just 1 or 2 tenths of a percent and leave it there. It's not so easy as that. There are a lot of other factors that come in.